Hey everyone, welcome back to the Capital Mindset Show. Today we're going to be discussing some boring stocks, the ones that might actually have some opportunity, especially as the market downtrends or we enter a recession. So by the title of this video, it may or may not be clickbaity. I haven't decided yet. But if you clicked on this video, you're interested in finding out what might one find opportunities during a recession. Well, one of those opportunities, not the only one, but one of those might in fact be, interestingly enough, the industrial sector. And why might that be? Well, if we actually kind of think about it and break it down from this perspective, one of the largest sufferers of an economic slowdown will be the industrial sector. And different parts or different components of the industrial sector will be hit harder than others. This allows us as investors to kind of shift through the rubble and pick out the ones that we deem to be worthy of adding to our portfolio, ones that we think will come out stronger outside of this or on the other side of this storm. And, coming into it, we might see a tremendous amount of weakness. So I'm going to be going over some of you. By no means is this an endorsement of all of them or any of them, or maybe it's an endorsement of some of them. I have no idea, depending on how you interpret the meaning of this video. But for the most part, I'm just going to be going over some of them, sharing my thoughts with you, and it's just as much of an exploratory video for you as it is for me. Okay, so that's the point of this channel, and I hope we kind of go on this journey together. So the first company that we're going to be discussing is actually one called Dow Inc. So if you actually were to search the stock, you might get a little bit confused as to why Google's not returning it to you. And what you want to do is make sure either you're using Google Finance or you're actually typing into the Google search bar Dow Inc. stock, and that will return to you this exact picture that you. So taking a look at the stock price, it is basically down, if you look at the 6 months, by 13.40%. And I want to highlight, and you've been probably seeing this in some of the live stream that we've been discussing, kind of showing or highlighting this drawdown right here. And this is no coincidence. So if you see oil's price action more recently, I look now really intelligent because of when I sold oil stocks. And I discussed that with both you guys here on YouTube, within the Discord, all around. And there are even videos in which case I showcase my thought process as to when I'm starting to trim down those oil position or those oil stocks. All in all, I'm no longer exposed to oil nearly as much as I used to be. Well, actually at all. And the last bits, and I've had questions, so I have responded to you if you have asked this question, why do I hold so little in Rio Tinto and BHP? Well, those are on their way out still. Okay, so I'm still taking or exiting those, and we've already taken plenty of profit from BHP. I'm very happy with the performance on that one. So going into something like Dow Inc., well, I just want to connect those dots here with you guys as to it's not a coincidence that they are also kind of coming down as we see oil prices also come down, because more than likely, if I had to kind of explain this out, would be that these companies are kind of precursors to that price action in those commodities. Okay, why is that? Well, if we think about Dow Inc.'s end customers is, highly dependent on the sensitivity or the health of the economy. Okay, so a lot of the products that they produce end up in the products that we consume on a daily basis. And if aggregate demand does drop, well, we should expect the overall, sentiment around companies like Dow Inc., LYB, which is a position within the portfolio, to also come down. And so that's why you see that sudden drop. This is why I'm highlighting these companies to you, or some of these companies to you, and because they may be of interest if we deem them to be worthy to add to our portfolio. So Dow Inc. is a leader in what it is they do. They are a chemical producer. They provide a massive amount of products. Just think of them as the little Legos that make up your life. Okay, all the things that they produce are going into a lot of things that you consume. Okay, that's as simple as I can probably put it for you. Now, one thing I want to highlight as to what might make Dow more interesting than other competitors within the European space or the EU space is natural gas prices. So Dow Inc. is the American variant. I own LYB, which is a European variant. There are other European variants that I could actually pick and choose and kind of describe the same situation. But for the most part, we have that LNG input in order to produce a lot of these products. Energy, just think energy as an input. And so what's happening right now? Well, energy prices have risen in a lot of places. Let's stick to LNG or natural gas. And so what's going on in the United States is actually a kind of almost like a easement of sorts, okay? Because for lack of a better term, supply dynamics are actually returning back to normal relative to demand, okay? But something is happening in the EU, which I want to highlight to you here. So this is the EU chart for natural gas. Natural gas is actually on the rise quite drastically throughout the year, and I'm putting out the 1-year price target. So this is actually having more so to do with the turmoil going on with the war, the conflict, Gazprom, all that jazz. So what's going on? Well, that's bad news for the European producers or the European competitors for a variety of reasons. Well, one, it actually leads to drawdown in margins because remember, please remember this, just because prices rise does not mean input costs. Let me rephrase that, input costs. So the cost that it costs you to produce your products, just because that rises, does not mean you get to raise your prices, because you can get rejection by the end consumer. They're not making as much as they should be, or let's say relative to the cost that you're trying to ask for. Therefore, they are going to just consume less because they just simply cannot afford that. So we have what's called a rejection of prices. So your margins are going to come down. But on top of that, you have an excise political risk. Well, what do I mean by that? What kind of political risk am I talking about? Well, the political risk that I'm kind of referring to is that potentially we see that, European lawmakers say, hey, you're using up a lot of LNG. We are going to ask you to use less of it. So not only are you going to get squeezed on the margins, but you have the potential to also get squeezed on the volume. So you're not able to sell as much product, bringing down profits even further. This is a risk for the European variants. And I kind of ask you guys out there for the European audience, because I know a lot of you are European actually. About half of Capital Mindset's viewership is from the European audience. So you guys can probably attest to what's going on within your country, and you can provide some color to some of us across the pond, so to speak. So this is one thing that's kind of I want to highlight as a risk or to a benefit of Dow Inc. Because what this means is at the end of the day, Dow Inc. might be able to gain market share, gain a stronger footing in the industries that they compete in relative to their competitors. Now, what are some of the actual benefits of companies like Dow Inc., LYB, and all these other chemical producers that we're going to be talking about today? Well, for one, they're very boring businesses, and something I would discuss as kind of like a philosophical sense of investing. Boring businesses are not necessarily boring, right? I would say that businesses that make us money over long periods of time are nice, and especially if there's a lack of disruption in those specific categories. Boring businesses don't have to be necessarily verbatim boring. They could just be ugly businesses as well. So stuff that is, let's say, industrial chemicals, stuff that, bad for the environment, all that stuff, that's considered maybe ugly by the investor class and oftentimes can be overlooked. And this can provide us with opportunities that, again, because there's less competition, there's less people looking at these assets. For those of us keen to add these to our portfolio, we might see better prices relative to other types of assets. And then we might actually even see growth, because at the end of the day, we as consumers might end up needing their products no matter what. Okay, so a lot of these companies like Dow, like LYB, and like these other ones I'm going to mention, you actually have experience with on a daily basis. You just probably don't even think about it, okay? So let's actually go to the financials of Dow, and let's actually see if there's anything of concern. And, I'm going to kind of spoiler alert, there really isn't. This is a really well-run ship. So Dow Inc. is a leader in what they do. And if I showed you here, they have cash about $3.14 billion. Nothing really to sneeze at across the asset lines. All in all, goodwill is not tremendously scary in terms of total assets. So you see total assets of $63 billion. Goodwill is only about 8.7. That's from their acquisitions over time. I also want to highlight that Dow Inc. used to be part of Dow or DuPont, and it was called Dow DuPont. The two companies have separated, and they've become two separate companies. They kind of focus on different types of chemical productions, and we're going to mention DuPont later on in this video, but not as a stock. That kind of almost deserves its own video, but for a good reason. Now, going on to the liability section, we do see long-term debt due within 1 year. That's a short-term, okay, so $355 million. They have plenty of cash to cover that, and we go down to the long-term debt pile. It looks like a big chunk of change, but relative to the operation of this business, I wouldn't be concerned. So nothing to kind of scream and say, oh my gosh, this company's going under or anything like that. Nothing at all. So if I go over to this model and I actually, let's plug it in. So we go Dow, and let me actually move you guys so you guys can see this better. All right, so when we plug in Dow Inc., we actually get a strong buy forecast by analysts with a price target of $64.06, implying a 25.17% upside there. Now, with Dow Inc., I want to take us down to these numbers. We do see kind of fluctuating revenues. Of course, the company is now on its own. We want to actually then highlight the kind of volatility in these sales figures to show some sort of, or a semblance of, cyclicality. But what I want to point out is in 2020, we did have a significant slowdown for obvious reasons. Economy shut down around the world. So I want to give them a break for that. Okay. So I'd probably say it is going to come down a bit relative to previous years because we are we are in a recession of sorts. And then so cash flows are estimated to go up by analyst estimates. Again, that could be because more cash is just going to be coming into the business. That was from previous line items or previous accrual accounting recognitions. And then shares outstanding has remained rather stable. Of course, this is a brand new business, so we kind of have to give it some leeway there. We don't really know what management's going to do. I would assume that they're not going to be very dilutive. They're going to probably use more of a debt form than necessarily an equity form. Now, if I'm going to, kind of map this out, I looked at what some analysts were actually projecting. Ignore the 25 and all that percent. In reality, I think the higher points could be about 10-ish%. And for this company, especially given where we are, I'm probably going to actually ask for a bit of a higher margin of safety. And with that, we're kind of actually at the higher ranges in terms of growth, but not too far off. And then you could say, or you could make the argument that I'm being a little bit too conservative, and that's fine. I can see that. So with this company, I'm actually looking at prices right now as starting to be interesting to build a position. Again, ignore the 18%, stick with me with the 10%. And in reality, I might actually turn this into the 12% because, again, probably being a little bit too conservative. And so in reality, this is kind of what I'd be picturing here. Let's do 8%. And then let's draw it down to a 5% in a very bearish scenario. And then even a greater bearish scenario, let's even say 0%. So those are the prices that I'd have to be interested. If I actually want to lower my margin of safety, well, the color's a little bit different. I can actually be a little bit more conservative in terms of my growth estimates. So I like the business. I think that, I wouldn't be surprised, or you shouldn't be surprised if you actually end up seeing this in my portfolio in some fashion. I like the leadership of this business. I like the differentiation from its European counterparts, and it has different exposures that, I just don't really have to worry about. Now, the next company we're going to be talking about is actually a company some of you might have heard, and that's Corning. So Corning actually is a very interesting business. If you have a cell phone, let's say the iPhone, you probably have touched a Corning product at some point. And no, it's not the phone, but it's the glass on the phone. So the glass that you see, that you touch, that you feel, when they say Gorilla Glass, et cetera, blah, 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 it's resistant to, breaking, et cetera. Well, that's Corning right there. So Corning produces a variety of products. They are still a chemical manufacturer of sorts. They also specialize, and they are the leader in fiber optics. Ever heard of that thing? Yeah, fiber optics. I know that some of you might hear fiber and you think, I got to eat my fiber in the morning, got to eat some cereal. It's not that kind of fiber. We got to have some jokes. I know, cheesy, but regardless. So Corning has underperformed the market tremendously over the past many years. If you look at the 5-year chart, they are only up 5.38%. So, you're saying, Fabio, you're showing us this really boring company. Yeah, that's the point of this video. The point of this video is to show you boring companies. These are all very boring companies. Get used to it. The next company is going to be also pretty boring, but there is beauty in these boring, ugly companies. And while the company has struggled to return, value to shareholders in the form of capital appreciation in the past, that does not mean we should discount it in terms of its ability to do so into the future. Now, something I'm going to highlight is if we actually take a look at the numbers here, the P ratio is a 25.56. Looks very expensive. So we're going to actually investigate this, and I haven't seen this yet. So this is actually going to be raw. We're going to look at the financials, and I'll actually pull it up with you guys here. So we're going to go to the website. And we're going to go to the investors page. So we just, Control F, let's find investors. So explore investors relations. Okay, so let's find and explore where can I find the actual financials. So financials and filings, click there. SEC filings. All right, beautiful. Where do I want it? Okay, I'm either going to choose to do the annualized one, and I'm probably going to choose that one if I find it. I can just do it by form here. So all form annual filings, 10K, and I'm going to choose the PDF variant because that's the one I prefer to work with. Unfortunately, I probably regret my decision already because they don't have the hyperlinks that take me right there. So I have to kind of navigate it here on the side and find it. I'm doing this to show you that I'm finding it pretty much raw. Okay, they have the hyperlinks towards the end, which is kind of silly. All right, so here I found the balance sheet, and of course I'm going to zoom in for you. Do not worry. So if I am looking at it from the perspective of a year-over-year basis from 2020 to 2021, ending on December 31st, what I want to find is if there's anything kind of off, right? So this is just a quick look that I'm basically doing here. So I'm looking through the current assets, nothing crazy change here. I do see that the cash has been drawn down. Okay, that's fine. That also is the pandemic, so nothing crazy there. Now debt is, I'm very surprised and very happy to see that actually debt went down from 7.8 billion to 6.9 billion. So good on them there. They're actually lowering that leverage on that front. Now I'm going to actually take us over to the statement of cash flows, because here we can actually see the net income of those same time period, and we see 960 million, 512 million, and they even show us 2019. But remember, 2021 was a strange year. So 2019 down, then up to 1.9 billion. All right, so let's look at the cash flows to see how the cash flows did. So during that 2020 time period, they had a lower net income, but really high cash flows relative to that. So an actual positive surprise on that front. Now, if we go down the list, if we see what kind of caused that, we can kind of explore this together. So what I'm seeing is that we see, okay, severance payments was a bit higher in 2020. So, note on that. Changes in assets liabilities. Okay, so note on that. That's a little bit higher, or, significantly higher. And we do see transaction-related gain, a reduction in that because that's not a cash expense. Or not that it was, sorry. They actually are reducing it because it is a cash expense. Sorry about that. And then claims on payments. Okay, so they have all these line items that weren't included in previous years, so that adds to a bit of the discrepancy there. Depreciation's mainly the same across the board. So in reality, a lot of it has to do with probably the slowdown, and that's coming from, I'm seeing the net income level. So the net income is much lower in 2020, especially relative to 2019 and 2021. But, as far as operations go, they did a lot better. Now, if I want to go to the income statement so I can kind of get a feel for their sales, I can find that by just looking for it. Let me see here. Yeah, right here. So net sales, we do see an increase in sales. So the sales went up. Cost of sales also went up. Gross margins also went up as well. So we see gross margins of 5 billion relative to the 4 billion in 2019. Again, boring business. All in all, analysts are expecting a decent amount of growth. And with that, I would just kind of want to then take us back to the income statement. And if we see that the company is trading at a basic and diluted, let's use, for example, basic in this instance. So we take about $1.30 in terms of earnings. We take that divided by the share price of, what was it? Let's see. And this is going to be like kind of my smell check. 31.91. In this instance, it does appear as though, yes, it is trading for a elevated multiple of sorts, all right, relative to the market. Now, in terms of cash flows, it probably is trading a little bit cheaper. So we're going to go over and take us over to the model and see what we can kind of figure out with this. So let's put GLW. And so with GLW, we're going to let it kind of pull forward the data for us, and I'll move you guys a little bit so it looks a little bit better. All right, so analysts have it at a strong buy rating with a price target of $44.65. This implies a 39.92% upside right there. Boom, awesome. All right, so this company is definitely trading on the more expensive side relative to Dow. So I showed you guys Dow, and now I'm showing you guys Corning. Corning's more expensive. No doubt about that. All right. So all in all, let's kind of scroll down through here. Revenues are expected to go continuing up and to the right relative to the previous years. It is expected to go down from 2021. Okay. So yes, recession. There we go. Cash flows are expected to rise according to analyst estimates. Okay. So that's the estimates there. And shares outstanding have been declining except from 2020 to 2021, where we did see a bump up there. They might have, decided to make some acquisitions, or maybe, their shares, they saw that they were trading expensive and management was like, hey, shares are expensive right now. We can get a lower cost of capital if we just issue some shares here. So all well and good. all I'm going to kind of say here is that based off of the growth trajectory, I did see analysts estimating anywhere from 15% on the higher end, and then, on the mid or lower ends, about 12%, or sorry, 10%, sorry, a slip of the mind for some reason. And then I will actually put in a 13% to kind of do that midpoint. So what I kind of get from this, and I'll keep 5% and 0% for a very bearish case, is that the company is not trading at any sort of discount, unlike the previous company. And I'm not even including buybacks here. So I'm just kind of remaining it at kind of a neutrality. But all in all, I do think that if we kind of look at it from the perspective of, what are analysts estimating, what do we think might happen, and, let's say we need that margin of safety because there's really an unknown factor with how bad this recession can be and how quickly it can come down. I would probably need to get a very good price on this company. And so what I kind of am getting from this, and these are kind of my thoughts, my closing thoughts, and again, we just did this live, raw, how I feel about this company is that the rest of the market kind of understands that its business model is very stable. It is in a lot of products that we do experience. It does have these tailwinds, so it trades at a relative premium to its peers or to other chemical producers or industrial players. Okay, so we're not going to be getting a bargain here necessarily, not one that doesn't come without extra risks or lack of safety or lack of margin of safety. So that's kind of how I'm feeling about Corning. And it might be that if we actually, and I'm going to explore this because I actually don't know. Let me actually pull up the max and see how this company has done over long periods of time. So, wow, absolutely insane. I didn't even know about that in the year 2000. So this is somehow was related to the dot-com bubble, probably because of fiber optics or something like that or akin to that. But all in all, I think I'm not going to pull it since the bottom, but hey, you know what? Why not? Let's do that. So 1,528%. I mean, I think it's performed decently well. Let's actually pull up, after financial crisis around there. And no, that's not actually that good. All right. Well, relative to the market, it's okay, but not the best performer. So I think it's mainly because the market probably tends to give this company a premium of sorts. All right, with that being said, we're going to kind of segue into the next company or the last company that we're going to be talking about, and that is the ticker symbol CE. Okay, so some of you have been already talking to me about this company, and I got to say, it does appear interesting. They're doing some interesting moves here, and that is Salence Corporation or Salence Corporation, however you want to pronounce it. And this one trades at a market cap of about $12.29 billion, another chemical producer. They actually engaged in an agreement with DuPont. All right, so DD, funny ticker there, but DD is the ticker of the other company, and they're actually purchasing let's see here. I wrote it down here. They're acquiring a business from DuPont for about $11 billion in cash, and then it is the nylon and elastomers business. We can also call it mobility and materials unit from the company. And so, think of your cars, etc., all of this stuff. So this is now what the company is going to be doing. DuPont in those key businesses or those key lines of businesses, they are a very well-recognized brand, and this will undoubtedly make Salence a leader in those key areas. Now, Salence has a lot of businesses that are related, so it's a very good tuck-in acquisition, I believe. And it's a company or it's a business line that I think Salence is doing a good thing. Now, it is supposed to close at the end of 2022 following regulatory approval, so we have to see how that goes. But I think if they manage to do it, management's actually doing a good thing here. They're going to take on some leverage because we don't really know the makeup of how that $11 billion is going to come out. Let's wait to see it when we get more color from management. But I do think that it's going to be, I don't know if it's going to be some form of stock issuance or just debt. Maybe I kind of hope it's just debt if the rates are good, because they've been doing a lot of buybacks, as we'll kind of show you in a second. But, all in all, the company's not very the leverage is it has a decent amount of leverage. Okay. And we'll actually show that in a second right now. Okay, so what I'm taking you here is to the balance sheet of the company, and when I said decent amount of leverage, remember I'm talking about also with the potential for this acquisition that's going to be about $11 billion. So relative to that, there's going to be a decent amount of leverage after all is said and done. So we see a current long-term debt of about $3.1 billion, down from $3.2 billion. Cash is sitting at, and if I take you up there, $536 million. With trade receivables of third-party affiliates being at about $1.1 billion. Okay, so when all is said and done, that leverage might actually rise up a decent amount relative to the market cap. So probably about greater than the size of the market cap if it's all debt, or maybe it's some form of debt and equity, maybe some preferred stock, etc. So they don't really have right now preferred stock issued and outstanding. So, all well and good, they don't have that debt there. But so they have it just in the form of long-term debt. So I want to see how that kind of plays out. After that happens, I presume there's going to be a decent amount of leverage, but I think management's doing so in a responsible fashion. They're acquiring a good business, a solid business that's a tuck-in acquisition, should be really up their alley. What I don't really like is when management goes out and starts buying a bunch of assets that they don't really have an understanding of managing. That can be a big risk, okay? So looking at some of the other line items like goodwill, well, we should see this actually increase when they actually purchase this asset. But goodwill is sitting at about $1.4 billion. In terms of total assets, it's not absolutely crazy, something to kind of rave about as something being a risk. If I take you to the quarterly, nothing really much has changed. Long-term debt's about the same. So we should see the real change happen after the acquisition. Now, if I actually go take you over to the model and we actually plug in the company, we're going to kind of make some assumptions here or look at some of the things that the model will tell us. And with that being said, it says it's a strong buy forecast by analysts, price target of 157, implying a 39% upside there. And if I take you down over here to the revenue, again, some cyclicality here. We should see an estimate rise, or analysts raise their estimates if the deal actually goes through. Again, that will probably be, again, from the actual acquisition from the company. Now, cash flows are estimated to actually have a nice little jump, but I don't expect that to be, continuing in that trajectory forever. So keep that in mind. We're going to have to do some, we don't want to have to do some normalization because we're not taking into account estimates, but we don't want to actually include and assume that growth rate's going to be there forever. Now, shares outstanding is continually declining. I kind of hope that they don't issue a ton of shares because I might think that, we're going to do an analysis here and we're going to kind of determine if you're of the opinion that shares are cheap, you don't really want them to use, you want them to use as much debt as possible, but if that debt isn't that expensive, that's the key, because if the debt gets to a point where it's so expensive, it might actually make sense to use equity, okay, or a combination of the two to some form or fashion. So if I go back up here, I'm actually going to keep a lot of these growth rates that they do assume. I'm going to not assume any buybacks continuing for here on into the future, but with the new business line, there is a ton of potential for them to actually grow a little bit more. So I was looking at some reports regarding the acquisition and the synergies that can be experienced. They can actually increase that growth rate to upwards of 15% is possible. It is possible. Now, depending on how severe things get, that changes things. So what I'm going to do, similarly to how we looked at with Dow, is I'm going to demand that higher margin of safety. What this kind of indicates to me is that currently the company is at a price point where I'd be interested in probably beginning a small position and then building it out over time. So this is one of those, again, quality companies that I'm kind of seeing as, okay, well, in a slowdown, definitely their business is going to get hit. There's a lot of things that are up in the air for questions. I think the market's going to kind of determine that as well, or it's going to kind of say that to me as well in the form of price action, and I might be able to pick up some shares at attractive prices. And I kind of think that for Dow as well. So kind of overall, my summary on all these stocks is I'm going to say, while the economy is in a slowdown, it is in a recession, we just have to wait for the government to actually declare this. I do think that for the keen investor, we're going to find a lot of opportunities out there. And for me personally, I think that one such industry, one such sector is going to be the industrial space, because I think investors are really going to hit this hard, or they are hitting this hard right now. And so among the garbage or the trash, so to speak, we're going to be able to find some and pick some up that are interesting. And that being said, if you pick up quality companies, after all is said and done, the quality companies are going to have perhaps even greater market share, a greater footprint in order to actually compete against the ones that were a little bit weaker. Survival of the fittest in the case of markets. So if your company can't really handle the slowdown, well, unfortunately, you might not be cut out for it. But all in all, I like Dow and I like CE as well. So GLW is a little bit too expensive for my taste, but I'd love to hear your thoughts down below. What do you guys think? As well as, remember, this is just the preliminary look. We'd have to actually do a little bit more digging, but some of you might have already done some digging into some of the business lines and found other key points of weakness in different parts, and we might want to share it down in the comment section below, and we can continue the conversation there. On that note, guys, thank you guys so much for watching, and I'll see you guys in the next one. Bye.